Hello, I'm David Frazier, aka the Market Monk, and this is our daily Market Monk show where we strive to tell you everything that you need to know and nothing more regarding factors and developments that we expect to affect the value of your investment portfolio. So let's get started. Today on Friday, May the 30th, the S&P 500 index recorded its 13th new high since the beginning of this year, while the Dow Jones Transportation Average also continued to move higher. In contrast, the technology-laden NASDAQ Composite Index, as well as the small-cap Russell 2000 Index, pulled back very modestly today after rebounding substantially over the previous 8 days. Europe's major stock market indices also continue to move higher today, while Brazil's Bovespa index pulled back considerably over the past couple of days after Brazil's central bank announced this past Wednesday that it is maintaining its key lending rate at 11% in an effort to combat inflationary pressures in that country. And largely as a result of Brazil's central bank raising interest rates there several times over the past 9 months, Brazil's economy continued to slow during the first quarter of this year, which government officials reported today out of Brazil. Slowing, even though Brazil's economy expanded at a 1.9% year-over-year rate during the first quarter of this year, GDP has grown at a slower rate during each of the past 3 quarters, and largely as a result of these interest rate hikes. In contrast, government officials in Japan announced today that construction spending in that country rose sharply in April, and that's obviously a positive development for Brazil. Now, those are really the only major economic announcements today. However, we did get a very positive geopolitical announcement today from the Pentagon. A spokesperson for the Pentagon said today that their research and just analysis of what's going on at the Ukrainian-Russian border indicates that the Russian military withdrew approximately 2/3 of its troops from Ukraine's eastern border with Russia over the past few days. So that's a very, very positive development. In regard to other developments today, in the U.S. stock market, as I mentioned yesterday, even though we've got a lot of positive economic undercurrents that suggest strongly to me that the pace of economic growth here in the United States is going to increase substantially during the second half of this year, and that stock prices here in general will likely continue to move higher and substantially higher, in my experienced opinion. Stock prices in general appear to have risen to substantial overbought levels. And the overall trading action in the U.S. stock market indicates that stock prices in general, U.S. stocks that is, will likely pull back a bit during the next few days or over the next few days. But I expect that any such pullback to be very temporary, and for stocks in general, U.S. stocks, to continue their uptrend that has been going on for several months now. I'm going to glance at my notes real quickly. Boy, I didn't mention anything about, I mentioned some announcements out of Japan, Brazil, and regarding that is, I should say, and regarding economic developments in those countries, or economic statistics that were released this week. But I forgot to mention the latest major economic announcement out of the United States, and it's a very significant and very positive announcement, and that is the Chicago purchasing managers, that is purchasing managers at manufacturing facilities located in and around the Chicago area, in the Midwestern United States, if you will, said in surveys that were presented to them from the Institute of Supply Management over the past couple of weeks that manufacturing activity in the Chicago area expanded sharply over the past several weeks. In fact, those purchasing managers in the aggregate said that the backlogs of orders from retailers and wholesalers for manufactured goods rose over the past 4 weeks to the highest level in the past 3 years. That's obviously a very, very positive development. And approximately half of those purchasing managers said that they plan to increase the size of their workforce over the next few months. So that's also very, very positive. And the reason that the manufacturing activity rose substantially is quite simple, and that is retailers of manufactured goods increased their orders for manufactured goods to replenish their inventories, which had been drawn down considerably over the past several weeks due to a big increase in the demand for those goods from U.S. households in that region of the country. So that's a very, very positive development. Now, I don't know if you've noticed, and I don't know if I mentioned, but generally speaking, when I discuss economic factors and developments from around the globe, I tend to focus on leading economic indicators. Indicators or statistics, that is, that tend to change direction before a change in the overall economies in various parts of the world. And in other words, I don't care about coincident indicators. That is, indicators that tell us, not really indicators, they're statistics that reveal what's happened in the very, very recent past, or lagging indicators. Indicators or statistics, that is, that tend to change direction several months after a change in the overall economy. That's looking in the rearview mirror. I don't care much about those indicators. For example, personal spending statistics and personal income statistics were released today by the U.S. Department of Commerce. And but I don't really care much about those statistics. They're telling us about something that happened in the past. I'm much more interested in leading indicators, such as this Chicago Purchasing Managers Index from the Institute of Supply Management. I care about economic statistics that have value and tell us what's likely going to happen in the future. So those are the type of economic statistics that I tend to focus on. Now let's get into another area, and that is gold prices. As I mentioned yesterday, the price of gold bullion has been trending lower since October of 2012, and as I said yesterday, that came as no surprise to me. And by the way, I can back that up very strongly just by the fact that I advised subscribers to our one of our newsletters to sell short gold via an inverse gold ETF fund approximately, oh my gosh, it's been almost 3 years now. I don't know, maybe it wasn't 3 years, maybe it was only 2 years ago, but very, very shortly before, so I guess it's really only a little over 2 years, gold started moving lower. So, you know, it really does come as no surprise to me that gold has been trending lower. Rebounded a bit a couple of months ago, but now it's moving lower again. And as I said yesterday, I expect gold prices in general to continue to trend lower. And the reason being is there are no major inflationary problems here in the United States, nor in many parts of the world. Yes, in some parts of the world, Brazil is an example, but throughout many of the regions of the world, there's just almost no inflationary pressures whatsoever. And gold prices are determined largely by actual and expected inflation rates. Now, a couple of other comments regarding gold. Let's see, I usually don't hesitate here, but it's been a very long day for me, quite honestly. Been doing a lot of research and analysis. And so some other reasons or some other factors / developments that seem to support my thinking on gold. Two very important subjects are the exchange rate of the U.S. dollar and the velocity of money here in the United States. The exchange rate of the U.S. dollar has continued to trend higher since March 8th of this year, and the velocity of money, that is the number of times that money is spent in the U.S., number of times that money is turned over, the velocity of money, has fallen sharply over the past couple of years and continue to move lower during the first quarter of this year. And the reason the velocity of money is a very important factor is that the mere fact that individuals, households, and businesses are turning over money at a slower and slower pace, in essence are spending their income and wealth at a slower pace, it strongly supports that, well, if people are not borrowing and spending a lot of money, you can't have inflation. It just can't happen. And the exchange value of the dollar also is a good guard against inflation rates rising. I mean, if the exchange rate of the dollar rises, which it has been, that means U.S. households and businesses can purchase foreign goods at a lower price. And, there's other factors that go in that, but I'm not going to get into it here. As I said yesterday, I tend to get more detailed in our financial newsletters, which, by the way, you can subscribe to if you're not already a subscriber by going to our internet website at www.themarketmonk.com, looking at the gold-colored menu bar, moving your eyes over to the right-hand corner of that section, and there's a link, a menu item there for financial newsletters. And you can subscribe to one of our newsletters at absolutely no charge, a free trial, truly a free trial. You don't need to enter any credit card information. All you need to do is put in your name and email address, and you can subscribe for free for a period of 2 months. Okay, so stock prices, in my opinion, to summarize here, are going to continue to trend higher during the second half of this year and are going to move substantially higher, in my researched opinion, but seem to be overbought here on a very short-term basis and due for a modest pullback over the next few days. And gold prices, in my opinion, will continue to move lower, and I expect futures contracts on gold to fall below $1,200 by the end of July, and very, very likely to fall below $1,000 by the end of this year. So if you're holding gold for speculative reasons, and you haven't gotten out of it, I urge you to do so and sell gold short, or do so indirectly by buying a gold inverse gold fund. That's it for today. I thank you for watching and listening, and I'll speak with you again tomorrow.